Hey, good morning, everyone. Marty Missouri here. Monday, July 19th, 2021. Going to do a couple of things with you here on the video. Going to keep it relatively quick. Wasn't able to do the macro update for you last week as I was out of town, but did update the index, and week over week it is flat. 35.42 was our score this week as it was the previous week. Still far enough above zero to say that recession risk presently remains low. Good thing. Four of our inputs actually did change scores. It's just that they balanced each other out. Weekly mortgage apps got better. Commercial and industrial loans got worse. Rail traffic got worse. But the economic surprise index actually got better. And the four just moved one notch each and kept us again where we are currently. So that's all I'm pretty much going to do, at least in the specific macro relative to our index commentary. Because what I really want to do is share with you from Lynn Alden's, she's an outstanding macro strategist, monthly newsletter. She points out something that we pointed out here as well, and that is that presently, if you look at this red line right here, U.S. households have more stocks as a percentage of their net worth than they've ever had. In 1999 was the previous peak. Stocks as a percentage of financial assets, which includes our real estate and bank accounts and so forth, that just peaked into all-time high territory as well. And then what she does here is she shows the previous record and then one before that, which was in the 1960s, but the 1999 record. And then the histogram, the bar chart down here, shows us the following 10-year return, and I'm going to give you my chart on that, after that peak or from that point. And so the stage that she's setting here, and I think it's a good stage to set, is that forward return expectations, well, we shouldn't have them set very high at this point for the U.S. stock market. And here's from her commentary. As we can see, there is significant inverse correlation there. When stocks are cheap and households have low stock exposure, stocks tend to do very well. So that would be when that blue line was low. The 10-year return on stocks was actually quite good. You can see that the big moves in the orange bar is higher. So from low equity exposure, 10-year returns look really, really good. Conversely, when households already have high stock exposure, there is less room for them to expand in valuation and allocation, meaning people are so exposed, there's just not necessarily a lot of new retail money, consumer money, that can come running into the market. These types of valuation and allocation assessments don't tell us much about 1 or 2-year forward returns, but they give us an idea of what sort of long-term returns we should expect. So it's all about setting expectations for U.S. stocks. For example, markets were expensive in 98, but that didn't stop them from getting more expensive in 1999. But then they actually, fell apart from 2000 to 2003, as many of you will remember. From this level, the broad market is unlikely to provide high inflation-adjusted returns over the next 5 to 10 years. And our work has to concur with that as well, which is why we're not overloaded in U.S. stocks anymore. And we haven't been since late 2019. And then she moves on to make a very interesting point. The blue line right here is the consumer price index, which is up a bunch, 5.4% year over year. And then the effective federal funds rate, the rate that the feds peg for overnight bank loans when banks trade reserves among one another. It's a key benchmark rate, and this is what the world looks at in terms of when the Fed takes action. Are they raising, lowering, or leaving alone the Fed funds rate? The range that they're targeting right now is 0 to 0.25%, making for lately an effective rate of 0.1%. So Len points out that this is currently happening because, along with large fiscal stimulus, the Federal Reserve is holding their key interest rate below the prevailing inflation rate, which is historically unusual. In fact, as Len says right here, the last time the Fed held rates this low while inflation ran this hot was the 1940s. And folks, as I've been expressing here, our analog for what's going on currently, and therefore our asset allocation, is really tilted toward that 1940s period. We're staying very diversified at the same time, but it's pretty obvious to us what the Fed has to do to keep these trains on the track, which is ultimately their aim is, despite today's 819-point sell-off in the Dow as I speak. Now back to this one, the household equity exposure from all-time peaks, forward 10-year outlook. I created a chart from that date right in there, which was roughly 1999, early 1999, and ran the 10-year looks. When we go back to that record stock exposure as a percentage of household wealth in early 1999, late 1998, you go 10 years out and U.S. stocks are down 26%. Now, I also folded in the areas that we have been now emphasizing more so in our portfolio over U.S. stocks. That would be developed markets, the orange line, commodities, the blue line, gold, the yellow line, and emerging markets, the purple line. Now, all of them came crashing down in 2008. So we don't know if there's a 2008 in our short-term or near-term horizon. But at the end of the day, as you can see, and I've shown you similar charts like this before, that during that 10-year time period, it was, even though U.S. stocks leading to that had just been killing everything, and I've shown you those charts where we have those decade-long intervals where U.S. stocks outperform foreign stocks and so on and so forth. So that setup that I've shown you already instructs us to increase our weighting to non-U.S. securities and commodities. But so does this data that Len presented us with this weekend, and that is just where U.S. households sit in terms of equities as a percentage of their wealth. Going forward from there, the last time we had that peak, you did much better, and particularly right up to when the market peaked, in things other than U.S. equities. And that's what we're expressing more so. We do have U.S. equities in our portfolio, but we're in the things like the energy space, which is having trouble today, which we hedged a bit here recently, as I shared with you on the blog, and materials and the kinds of things that we know, regardless of COVID scares or what have you, there is going to be literally trillions of dollars spent on infrastructure going forward. And a lot of that is going to be spent in the green energy space, which tells us what metals and minerals and miners and material stocks to emphasize. Between now and then, things are going to get really, really volatile. And let me finish up with a look at the chart that I've been playing with for years here on your behalf. So this is the S&P 500. I've really zeroed it in here to the last year. Here's that upward sloping wedge, which is a bearish pattern. And here we are finally breaking down below that trend line. Okay, that goes all the way back here to October 2020. Now, as you can see, this red line is the exponential 50-day moving average. How supportive it was here back in March of this year when it broke through there. And I know folks, you're feeling it, but it was worse back in March. We basically, it was saved by the trend line right here, actually created the trend line. And then it was just basically when you had double support, the market did okay, broke through there, but was saved by the 50-day moving average. Folks, this is today's bar. And ironically, you can see right here that people are buying this on the 50-day moving average, interestingly enough. Now, it breaks down below there, of course, and we've got some air pockets down in here, and this very easily could happen. I mean, the stock market, there's no guarantee, despite the fact that the powers that be want it to keep going up, virtually need it to. Doesn't mean that the market's not going to give them fits. It is going to inspire them to step in with more money printing and buying junk bonds, maybe even buying stocks if we have another last spring event. I think they've set up the mechanism that allows them to do that. But in the meantime, there's going to be some volatility, and they have to allow some of that, I suspect. And then zooming out a bit, I'll look at these supporting indicators. So here's our volume indicator, which you can see is actually broken down below that white line. And it is the summer months and so on. But as you can see, when we have an upward trend line, but we have dying volume, that's a bearish signal. You can see I rectangled in here these spots before the big sell-off last year, and I've got another rectangle building here. I don't know that this is going to be a 35% decline like we had during 3 weeks from February to March, but this signal says that this market, is heavy and is due for a correction, with or without this weekend's COVID scare. Here is the MACD, again, losing momentum. You can see we've had these bearish divergences. That's a sell signal right there. And then the relative strength index, or the RSI, was rolling over. So these are those bearish divergences that I keep showing you here. So these look like they're playing out a bit. ultimately that should play out anyway, regardless of the catalyst. And again, COVID's a good one right now when you look at the reports. This market was heavy and we were due for a correction. Now, clients, in terms of your portfolios, we're catching a good chunk of this morning's sell-off. Not all of it, but enough of it. Gold is up. Of course, our options hedges are up this morning and so on. But always remember, we're not hedging with the S&P options and even with the put options on the energy sector that we just placed. These aren't hedges to save us from corrections in the market. These are hedges to support our portfolios in the big sell-offs. Again, in the 35% decline sell-off, our most aggressive portfolio, which is 100% in our core, went down 12%. Retired client G went down less than 10%. If you were more conservative, you could be an aggressive retired client. Right now, the way our system scores another 35% decline, we're right in that ballpark. The full-on core portfolio is scoring at just over a 15% decline. Now, again, that's based on all of history, and it's based on the volatility index, which is in the price of options, being at the current level. Typically, if we have that kind of fall, the VIX is going to go through the roof, and that could help us a bit more. That would add more value to the options. So it could be something along the lines of what we experienced last year. So we're not attempting to get in the way of corrective type stuff, meaning 10% to 20% corrections. Those are just part of investing. There's just no way around that. We do want to mitigate a great amount of the big bear markets. Our portfolio is very different than it's been over the last decade, meaning that it's not even 60% in stocks. We've got a good deal in commodities. The biggest chunk of that is gold, which is a defensive thing to own. But we also have the base metal stuff. We also have the miners. We also have the things that we absolutely know. A tremendous amount of spending is going to be hitting in the coming months and years. Right now, we're seeing quite the correction there, and that's pulling our portfolio more in line with the downside that we're seeing in stocks. And lately, from about mid-June on, we haven't been catching the upside because we're not in those really frothy, growthy plays. The tech sector that just looks terribly out of whack in terms of percentage of the overall index and vulnerability and so forth. We've got some exposure there, but we don't have a lot because that's not where the emphasis is going to be. In fact, you could argue that tax policy, regulation, antitrust, everything that we're going to see over the next few years is going to be targeted right at those big tech companies that everybody continues to want to buy. I get that they'll do well in a COVID world. I do. But beyond that, if we're not going to live in a COVID world forever, that's where I see the biggest vulnerability. And ironically, it's something that keeps working. But like I read to you in Lynn Alden's report, stuff kept working in 1999 until it stopped. So what we want to do is we want to be into things that look fundamentally sound and cheap relative to what's been going up for the last 12 years. So along the way, though, we're going to have these periods where, and I illustrated this a lot on previous videos, where I love the commodity trade, but the darn thing went too far too fast. And that's where I was pointing as it was going straight up to folks, we're going to see significant downside volatility here. We need to see some consolidation. So some pullback was inevitable. The question is not short-term pullbacks, is on an intermediate and longer-term basis, is the thesis still sound? Right here, as we sit here today, that still makes the same sense it made back when it was knocking it out of the park, first part of the year. So right now, this is kind of that sitting tight, stick to it, stay hedged, be defensive where we can. But in those thinly traded summer months, it can get pretty ugly at times. And then suddenly you have all this doubt because COVID's back and so on and so forth. Of course, we know that's going to inspire new fiscal and monetary stimulus and all that goes with that. So there could be some upside here. And remember what I said in this morning's morning note. There's no reason to think there's not a buying opportunity here, but I'm not talking a 2%. I'm talking more like a 20% dip. And that's where we see something that may be actionable. And of course, it all depends on the context and what's going on around that dip. But again, folks, we are hedging against the bad stuff. allowing the portfolio to move with the normal volatility. And right now, at least as of from about mid-June on, we haven't been able to catch nearly as much of the upside of the market as we were earlier because it's been very, very concentrated, particularly in the tech space. Most other sectors are actually negative since then. But that's the stuff that continues to make sense, and it's the stuff that looks more attractive the longer that scenario plays out. I'll leave it there for now. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Bye-bye.